To me, 2025 really felt like it was going to be the year of mortgage rate reduction as a result of the federal funds rate reduction. And we know those two don't necessarily go hand in hand, but they kind of coincide to a loose degree. What did you take away from the decision not to cut the federal funds rate, number one, and then Jerome Powell's answering of the questions thereafter?
It's funny you say, 2025 is going to be the year, right?
Right.
And I grew up in Cleveland, and so unfortunately I'm a Browns fan. And I don't know how many years we've said this is going to be our year. This is going to be our year, and then that year, of course, it doesn't happen, and it's just some crushing defeat, But it's similar in the mortgage industry and the real estate industry. I mean, this has been worse than 2008, because it's lasted longer, 30-something months now that it's been, the lowest sales numbers, and, all of those numbers are down. Everybody's income is down. 20 to 30% of people are getting out of the businesses. So yeah, I mean, it's a little bit like, we thought it was coming down.
Comparing the federal funds meeting to the Cleveland Browns. I like it. That was not something I was expecting to be
Didn't see that
a
coming.
correlation
I like to surprise you. It's so these meetings and first question is why do we care?
Right.
Who cares what the Federal Reserve says or what the rate is, and what it relates to is the cost of credit. They have to get this money from somewhere. It doesn't just fall from the sky.
Right.
And so the cost of funds will play into mortgage rates to some degree. And really, that's one of the things the Federal Reserve does. They have a dual mandate, right? They want maximum employment with inflation under control.
Right. And that's what they're always trying to balance.
Right. And we got here, at one point we were 9% inflation rate or something like that. And now the goal is 2%. So basically what he said, and if you don't know the schedule, the number comes out at 1 o'clock our time, says they're going to go up, they're going to go down, they're staying the same. 30 minutes later is when Jerome Powell gets up and gives his press conference and discusses, basically a summary of what they did, and then he fields questions from these reporters. So, and he basically said a couple things. One, he said that the economy is doing well, that the labor market has cooled off from its overheated state that it was in, and that we're headed pretty definitely towards our inflation goal. We're not there yet. So one of the things he said is there's no reason to be in a hurry to cut rates. How did that make you feel?
Well, as a real estate agent who's actively in the business, it didn't make me feel great because I was thinking, that 2025 was going to be that year that we saw rates in the fives. And one thing that's really interesting, you come and present to our real estate team as our preferred loan officer, once a month or so. And the charts that you pull up always show the probabilities of what's going to happen, right? Are the rates going to be cut? If so, are they going to be cut by a quarter point, a half a point? Are they going to stay the same? Are they going to go up? And when you were presenting to us towards the end of the year last year, I think you got everybody really excited because the probabilities of multiple cuts on the chart that you showed looked better and better. And right now, the one you showed us this past week says that, the likelihood of us not cutting was like 98 or 99%. That's exactly what happened. We did not cut. Yeah. And then also the likelihood of the next meeting, which is going to be in early March, another cut not happening was what, 75, 80%?
Yeah, it was not, I mean, it's not very likely.
Right.
And one of the things that happened too is, towards the end of the year, the Federal Reserve kind of changed their attitude, where we went from, we're going to see another 1 point cut over the next year, in 2025. And then all of a sudden, not so much, because some of the data that supports their decisions had come out and looked a little differently than what they thought.
Yeah.
And so then they took that, well, we're only going to cut maybe a half.
And it seems to me like they're really riding on the jobs report. And as long as they're not, quote unquote, breaking the economy and putting a bunch of people out of work, they're going to keep things exactly where they are, even if it does cause our business to be a little bit slower than normal. Is that what, do you think that the jobs report is kind of the main driver here as to why they've decided to, take a cooler stance on cutting the rates as opposed to what they were saying last year?
I think there's a lot of things going on. One, of course, the labor market. They're watching the labor market to cool, but not too much. You don't want a recession. They're looking for the personal consumer expenditure, PCE, to come down because, as that comes down, that means inflation is coming down as well. And of course, they're looking at inflation numbers. But yeah, right now, jobs is a focus.
Yeah.
Because, and it has been moving in the right direction, we'll say,
right.
Which unfortunately is, more job loss, less employment because, if you got a job, you're spending more money.
Yeah, that's pretty self-explanatory.
Don't have a job, you're probably not. And which is kind of how we got, I don't want to make a political thing at all, right? But after COVID, the money kept coming. People started I didn't get any, but, they were sending out these COVID checks, as they called them, and there's an argument that maybe
the stimmy checks, as the kids were calling
them. The stimmy checks, yeah, a little too long. And it was funny, the Federal Reserve operates separately. He's not going anywhere because Trump can't do anything about it. He's on through 2026, as we've talked about before. But it was interesting because in this, now Trump's in office. This is the first Fed conference, Federal Reserve press conference where Trump's been actually president.
Right.
And so there's a lot of questions like, well, Trump said, and Chairman Powell's attitude is very much, yep, I'm not commenting on anything he had to say. As a matter of fact, I'm not commenting on anything that any elected official had to say.
Yeah.
That wouldn't be appropriate. We're going to keep our head down. We're going to keep doing our job. And it was asked over and over again, many different ways. And he didn't quite say this, but what I surmised is like, hey, I'm not going to listen to you guys, and you can't do anything about it.
Yeah, it certainly seemed that way.
Yeah, and that's probably how you want the Federal Reserve to operate.
Yeah, because they do need to kind of operate independently. The one thing about Trump, though, and it's, not to get political, but it is very difficult not to draw some sort of correlation between Trump and Powell because Trump is very vocal about wanting housing pricing to come down. Our last video that we did was specifically about the Trump executive order that's supposed to lower home costs, which I think we would all enjoy and love. Yeah. And so, the comparisons between the two, the friction between the two, what one says and how that's going to affect the other, vice versa, is something that I think Jerome Powell is going to field at every Fed conference until his term ends in 2026. Right. The one thing about Trump is he's very good at putting incentive in the right places, and he's very good at applying pressure. Right. Just look at the sanctions, just look at the tariffs that are coming out. So it'll be interesting. I know that's Powell's stance right now. I'm going to do things the way that I see fit. I'm going to do things in what I think is the best interest of the country and the jobs markets and inflation. But we all know that Trump is not going to be satisfied to sit on his hands until 2026 until he can pick a new Fed chairman. So I do expect that even if he's not going to answer the questions, he's going to be fielding them at every press conference. And the interesting thing looking now is we talked about, going back to 2025 being the year of the rate cut. We just had our first meeting. We know it didn't happen. The probability, at least from the chart that you showed us, is it's very unlikely that it's going to happen in March as well. Yeah. And so then we're talking about May, where I think what you showed us, or June, where you showed us there's probably, I think it was a 48.1% chance, if I remember my numbers correctly. So that's better, but it's still a less than 50% chance that rates are cut in May. So now it's starting to look like mid-year, and there hasn't been a cut.
And so what does this all have to do with? Right?
Yeah, really mortgages, I think, is what people want to know. The question I'm getting as a licensed real estate agent is, when are the rates coming down? I want the interest rates to come down. And I think it's worth, talking about how much are they expected to come down this year? And I know you don't have a crystal ball, but put it into context too, because rates right now, we're seeing them. I think you just showed me a chart that shows the conventional mortgage rate somewhere right around 7%. Yeah. If it goes down to 6.5%, what would that really mean for your monthly mortgage payment? Because the reality is most people out there who are just home buyers, maybe they're investors, they don't really care about Jerome Powell or what he has to say or the jobs reports or anything like that. They want a lower monthly mortgage payment. So what can people expect if the rates do come down let's say a quarter or half a point this year?
So, really the focus, of course, is affordability. And
Right.
it's a conversation that's been going on for, quite a while since rates went up. And so the average mortgage in the United States is $330,000. It's $329 and change, but I'll round up for the moment.
Yeah.
So let's say that rates go from, I don't know, 7 to 6.5, or on FHA they go from 6.5 to 6. By the way, 6 seems to be the magic number to really spur on sales right now.
Yes.
So if you go that half a point, it's dropping your mortgage payment by $110. That's real money.
Sure. Yeah.
Absolutely. But, a quarter point drop, it's $55. That's like 2 trips to Chick-fil-A. And if you bring the kids, that's not even that.
That's one. That's probably one. Yeah.
Yeah. I mean, to put it in terms of something we all understand, right? In our area, it's not just the mortgage payment that's been a problem. The actual loan payment, sure, that's gone up because the rates have gone up. But even if rates come down a half a point, I mean, $110, it's not thousands.
Yeah.
It's not, if you look at the average mortgage payment over the last 3 years, it's gone up something like 40%,
Yep.
44%. That's not all because of the interest rates. It's, your payment also has your taxes usually included and your insurance included. And so that $330,000 mortgage, is basically a $345,000 house with 3.5% down. And so that house is probably, $330 or so to insure a month in our area. Now, other areas, it's a lot less.
Yeah.
Let's get that out of, but that's a lot. That's a ton of money to spend to insure your house. That has gone up significantly over the last few years. Taxes, it might be another $500 or so for taxes, for this house that's included in. No matter what the rates do, those are staying the same.
Right.
Unless we get some insurance reform, that would be welcome for sure.
And I think a lot of people are talking about that. The Luigi Mangione being at the forefront of the news right now and what's going on with health insurance, the LA fires, and how it kind of came to light that a lot of insurers cut the fire coverage shortly before that. Yeah. And the insurance prices, because we're Texas, but we're coastal Texas, right? So we have a lot of cities that are suburbs. I don't expect anybody watching this to know Seabrook, Texas, Kemah, Texas, but just to suffice for the purposes of this video, those are the cities that are closer to the coast. They're more likely to be in a flood zone. You have to carry flood insurance. I have had, more than half a dozen deals bust out because the client got the insurance quote and they were just astronomical. Yeah. And so I think what a lot of people are focusing on is the mortgage rate. And in reality, as you just pointed out, you're talking about $100 a month at a half a point cut. You're talking about $50 a month at a quarter of a point cut.
Right.
We got to figure something out to get these insurance rates down and get these taxes in check, because that's what's making up the bulk of the extra payment. Of course, you have your principal and your interest, but that's going to be amortized. That's going to stay the same through the life of the loan. And so I think people are getting really caught up in these Fed meetings and these, they didn't cut. They're talking about pushing and not cutting in the March meeting as well. But the reality is you can do some creative things to get into a house. You can ask for the seller to give you some credits towards the closing, because it's not 2021 anymore. It's not COVID. It's not immediately post-COVID. There's not 37 offers on every house.
Right.
Most houses are taking a little while to sell right now, and so sellers are more apt to give credits. You can use those credits for a mortgage interest rate buy down if you so choose, but that's not really solving the insurance problem and the tax problem. So I'm glad that you brought that up, because I think it's important. And you also were telling me before we recorded something about the FHA looking at dropping mortgage insurance, and there's been some talk around that. What do you know on that front?
So there's some. It actually started with some senators, some congressmen are looking at it, and to kind of understand how this all works. So we use FHA because it's a significant portion of the market. In general, if you have a score below 780 or so, it's cheapest if you're putting the minimum down payment down. Cheapest to go FHA.
Right.
The interest rate will be lower. The mortgage insurance will be lower. Mortgage insurance only covers if you end up getting foreclosed on, and it covers the loss that your lender took. That's what FHA mortgage insurance or private mortgage insurance on a conventional loan does.
Right.
So, and back in 2008, There were a few foreclosures.
Just a few.
Just a few. Like an alarming number of foreclosures. And the FHA, all that FHA mortgage insurance goes into a fund to cover those losses. And so that fund was running dry in a hurry. And we were, maybe, I think it was 1% up front. So if you're financing a $100,000 house or getting a $100,000 loan, it was actually $101,000 because you financed that in. And then on top of that, monthly, you'd be paying like 0.85 or 0.5 at the time. So that means take your loan amount, multiply by 0.005, and that was your mortgage insurance premium annually, divided by 12, that's monthly. So $153 on a $330,000 loan basically is what it is now, where it's 1.75 up front, not 1. And it went to 0.85, now it's down to 0.55. So it's come back down a little bit as that fund is something like 470% over what it's supposed to have.
Wow.
To cover losses. So maybe it's time to look at doing some things. One of the things they changed a while back, this is, 2013, something like that. They changed mortgage insurance so it never goes away. So it doesn't matter how long you have that loan. Now, if you put a significant amount down and you do a 15-year loan, okay, it lasts for 12 years, I get that. But otherwise, it stays there the whole time. It goes down every year because it's based on your balance. But it doesn't go away like a conventional loan.
Right.
So one of the things they're proposing is saying, hey, let's get rid of it at 80% loan-to-value ratio or 78% loan-to-value ratio. So if you have a $100,000 loan, it reaches $78,000, it goes away. That $153, whatever the payment was. So that would help people long-term, for sure.
Right, sure.
What if we reduce that 1.75 upfront mortgage insurance premium down, to maybe half of that? Okay, that would really help your financing less. They're looking at things like that to help affordability. Back in 23, they went from 0.85. So multiply your loan amount times 0.0085, divide by 12. That was your monthly mortgage insurance premium on an FHA. Now they dropped that to 0.85 or 0.55. Okay. So it dropped significantly, which has helped affordability. But it's not just the rate is the point.
Right.
We're all focusing on, interest rates. I mean, okay, if it came down a point, all right, that's $220. That is not a car payment even these days. But,
right.
I was about to say it's a car payment, but good luck, in this market. But point is that, it is a significant drop, but how likely are we to see that?
Very unlikely this year.
Very unlikely. I mean, most of the people that are smarter than I, which that's a large group, but let's say, these folks are saying, well, we might see occasional dips here and there of a half a point or maybe a quarter point or something like, but nothing significant. We were looking earlier. What have rates done since the announcement on Wednesday? And they came down like 0.02 on the average or something like that.
Which is interesting because it's, when they cut the rates back at the end of 2024, the average mortgage price went up. So they cut rates and the average mortgage price goes up, but then they do nothing at this meeting and they go down slightly. Now, we're not talking about meaningful numbers, but I just find that to be like an interesting, statistic to see. Because a lot of people think the two are like directly tied together and they're just not.
Exactly. And that's really just not the case. It's kind of one influences the other. And so affordability, to really make a difference there, yes, mortgage insurance on an FHA loan, that's going to help. Yeah. But really it's insurance reform. Taxes actually, not super high. Around here, it's, 2% is usually the average we use of the property value. That is higher than other states. Yes. For sure. But, it's not, that hasn't skyrocketed. That's actually come down in Texas over time. The insurance, no. It's become a point where we used to use the sales price times 0.75 or something like that. Now that's like 1.35. Wow. Because of, and it's just the number of losses. Insurance companies are not charities either. Right. They're there to make money. So if they pay out a whole bunch of money, they got to charge more money to replace that money. Yeah. You don't want them to go out of business, right?
Yeah, we would all kind of be in a mess if that happened. And as bad as I have criticized insurance over the last couple of months, we still do need it.
We still do need it. I mean, it is a necessary evil, unfortunately. You know.
And guys, just before we finish up this conversation, we noticed that the majority of you that are watching these videos aren't subscribed to the channel.
Yeah, what's up with that?
Guys, if you're getting value out of these videos and you're enjoying our content, a subscribe to the channel helps us out tremendously, and it allows you to see our videos when we drop them. Now let's get back to the conversation.
Thank you.
So last topic of the day we got to cover, and since you're the mortgage guy, you get the question. We saw a hold in January. The March meeting that's coming up, do you expect another hold, or do you think we may see a small reduction in interest rates?
I think we're holding. I mean, you know, he said during this press conference, he said so many times, we're in a good spot. We're in a comfortable spot. We're in balance. We're where we want to be. You know, they're also, you know, it's not just about the federal funds rate, which again is banks loaning. It's overnight lending.
Right.
You know,
between banks.
Between banks or between the Federal Reserve and a bank. You know, that's the target rate is 4.25% right now, basically, and so you know that is going to stay that way. But that's not the only thing they do. You know, back when they're trying to prop up the mortgage market, sometimes the Federal Reserve will buy the mortgage-backed securities and bonds, long-term investments like that. They're not buying; they're selling.
Yeah.
And they have been selling for quite a while now. And so if they had come out and said, we're going to sell more, that would not help mortgage rates.
Right, sure.
You know, because it's literally competition for the new mortgage-backed securities we're creating.
Right.
So what he did say, though, is we're comfortable with the pace, basically, that we're not going to
We're not
sell
ramping
more,
it up.
we're not going to sell less, we're just keeping kind of how we're moving along. You know, head down, doing the job, keeping the dual mandate, 1,000 points of light. No, I don't know. You know, but that's kind of the mantra is like, yeah, we're just going to stay here for a while, and we're going to see what happens. It's all data driven, and it's probably summertime before we see any sort of rate decrease. It's not going to be a full point or anything. It's likely going to be a quarter.